targets?
At 3% growth, we are well below previous levels. If you look at the average over the last couple of decades, growth was around 3.8%. So when you're getting to 3%, we're looking at low numbers, and this is going into the medium term. I don't think we should be settling for this at all. It's very important for countries to undertake structural reforms that help to raise growth. There are some dynamics that are, of course, weighing on growth, which is aging, weaker productivity growth. But through the right measures, we should be able to raise productivity growth in the future, and that's what we need to do.
I guess crudely speaking, if you want to think about ways to boost growth, I mean, there are two passages that you can go down. You can either do it fiscally, or you can go down the path of structural reforms, which is what you just said. But for governments thinking about going down the fiscal route, it is also a very challenging time because their debt has ballooned so much over the course of the pandemic and because of the higher interest rate environment.
This is a difficult time. We have record high levels of debt at a time when interest rates are much higher than they've ever been in the past. And, you know, like I said, looking ahead, growth is not that strong. So that makes it a pretty tough combination. But there are certain kinds of public investments that pay for themselves. So when you invest in education, in health, critical public infrastructure, the digital transformation, all of that can raise growth and therefore through that raise revenues and pay for themselves. That's the kind of spending that will be needed, including on the climate transition.
What is the IMF advice to policymakers? Because again, it seems like a lot of that fiscal room was already used up throughout the course of the pandemic. So what should be the priority here? Should it be borrowing to invest more productively, or should it be bringing down your debt to more manageable levels?
Given the levels of debt that we have, and given where interest rates are, we're seeing an increasing share of revenues that governments get that goes to debt servicing, right? So that space has shrunk. But they're very important investments that they still have to do. So it's a multi-pronged approach, which is first make sure that you're getting the revenues that you need. There tend to be many loopholes in taxes. Make sure that you close it and you actually collect sufficient revenues. But on the expenditure side, you have to prioritize, right? I mean, there were a lot of discretionary measures that were put in place during the pandemic, during the energy crises. Those will have to be rolled back. And growth-enhancing investments help in terms on the fiscal situation.
What about low-income countries? One of the criticisms being leveled at the IMF is, out of the 650 billion SDR released in 2021, only about 275 billion went to emerging and developing markets, and only $21 billion went to low-income countries. Should the IMF be doing more to help low-income countries with their financing?
We are doing a lot to help low-income countries. So what you said about the initial SDR allocation is right because of the way it gets allocated. But since then, we've made a big push to have rich nations that don't really need these extra reserves to rechannel about $100 billion of reserves to low-income countries. We've gotten 87% of the way there, which is about $87 billion that's moved in that direction. We've done lending to low-income countries at concessional rates, which is basically zero interest rates, at record levels, working on multiple fronts with them. And it's not just the money that we lend to them, but in terms of our policy advice, in terms of capacity development that we provide. It's not going to be everything that they need. These countries also need to rely on their own domestic resources to be able to address their development goals. They will require help in the form of aid and grants from the international community, not just loans. There's a lot more that needs to be done also on the debt restructuring front. But we're here. This is the week when we're trying to accomplish many of these goals, including making sure we have enough money in our poverty reduction and growth trust to be able to help these countries.
Let me turn back to just sort of, a big feature of the global economy right now, and that has been the shocks that have come through from inflation, the post-pandemic surge, and a lot of that has come out. But again, there are signs of persistent inflationary pressures around the world. What is the IMF message to central bankers?
Well, firstly, we recognize that central bankers have done a lot of work. They've raised interest rates quite substantially. We are seeing inflation coming down. But our message is that the job is not yet done. It's important for them to remain focused on meeting their goal of bringing inflation back to target, because otherwise we cannot have durable growth and resilience in the economy. So they need to stay in the path. They have to be data dependent, of course. We are seeing the risks to inflation as more two-sided than it was before, when it all looked like inflation could only go up. It's more two-sided. But we are in a world of tremendous uncertainty. The events that we're seeing recently, I mean, really tragic events, all of that can have implications for prices. So it's important to follow the data and make sure that you bring your inflation back to target.
And just to circle it back to what we were saying about global growth at the beginning, how much of the growth slowdown do you think can be pointed back to restrictive monetary policy and the tightening that we've seen in credit conditions?
Well, recently what we're seeing in terms of growth slowing down has to do with the fact that policies have become tighter, as they should. Monetary policy has tightened to bring inflation down. So that's the kind of slowing of growth that we should expect to see. But that said, I mean, despite this very large increase in interest rates, in several countries like the US, we're seeing a lot of resilience too, especially in the labor markets.
And again, one of the big themes, we've spoken to many of the central bankers here at the conference already, and it seems like one of the major themes and takeaways is this higher for longer regime is going to be with us for a while. How do you think of that in the context of emerging markets, and how destabilizing that could be for some of those economies? Because it's not just higher interest rates, but it's also a stronger dollar recently as well.
Yes, we are seeing long-term interest rates go up, which really captures the essence of the fact that we are moving out of a decade of ultra-loose monetary policy to one where interest rates are high for a reason, to bring inflation down, and that is going to take some time. So interest rates will stay high for a while. This has implications for governments, obviously, because that means that the borrowing costs are higher, debt servicing costs are going to go up. It has implications for financial markets that grew up and lived in an environment of close to zero interest rates. In terms of spillovers to emerging markets, indeed, the currency channel plays another important role. So this is why it's important for all parts of government, central bank, fiscal authorities, financial regulatory authorities, to keep their eye on the ball, because we are in a very uncertain, difficult conjuncture.
Yeah, and finally, just to round it up, I do want to ask you about China, because one of the major downgrades that has come through from the IMF is on the Chinese economy. I was speaking to the department head for Asia yesterday, and we were talking through some of the structural issues there. But to what extent do you think China is going to be a determinant of global growth and where it goes to in the next couple of years? Because it's not just China slowing down, but the whole region on back of China.
China is a major economy, and has been growing at a fast rate. But yes, if you see our projections now, we have growth for this year at 5%, and it comes down to around 4.2% next year. And then over the medium term, we're getting to 3.4%. So our projection is for growth to slow. That has implications for the region. We've done a study that shows that when growth in China slows by 1 percentage point, on average, over the next 5 years, it reduces growth in many other countries by about 0.3 percentage points.
Right.
It, of course, varies by country depending upon your trade ties.
Yeah.
But this is meaningful. Now, it's not a given that China's growth has to go in that direction. They have this policy space with the right amount of reforms and right policy action that can be reversed.